This conference will now be recorded.
Okay, so good evening, everyone, and welcome back to a fresh new session of credit risk modeling. And we were talking about the capital models, and while talking about the capital frameworks, we started off talking about the Basel frameworks. And while we were talking about the Basel frameworks, so one of the things that we kind of saw over there was so we started off talking about uh, you know the uh, the capital tiers, the tier of the capital, the capital one tier, the tier one capital, the tier two capital, the key capital ratios, and the impacts that they have, and the respective impact that each of these capital tiers have in assessing the capital adequacy in their relative importance that they have in the capital models. Right. So while we talk about that, while we spoke about that, so one thing that we could find out that our objective over here is to find out that project to find out that capital to reach to their optimal amount of capital adequacy and so on, right? So uh, so over here what we have is the following. So what we were talking about over here, so the next thing that we started talking about in the last session was after looking into the different components of the capital and the tiers of the capital, the next objective over here was to look into the project. Was look into the different kind of exposures that the bank had, because the capital would be calculated based on the exposures. So once you get to see that how exactly this, so how the what are the different kind of exposures are, and depending on the characteristics of the exposures, we would get to study the different kind of the business, the different kind of business products, and based on those products we would be able to assess the risk characteristic, and thereby define the methods for developing the they will develop the methods for or identify the methods for developing the respective models, right? The respective modeling frameworks. So these are the different kind of the so that's the reason why we started exploring the exposures. And while we started talking about the exposures, we identified that there were two broad kind of portfolios. One is the retail portfolio, the other is the corporate exposures. The retail and the corporate exposures which we were trying to assess, and within that we started speaking about the different kind of the exposures which are there, right? So we started off talking about the corporate exposures. Now, in the corporate exposures, we saw that the corporate exposure is divided into two parts. One is the small and the medium enterprises. The second is the corporates. The second that I have over here is the proprietorship, and the next that I have over here is the partnership. So SMEs are divided proprietorship, partnership, private limited companies, and the way that the SMEs are defined is in terms of their sale proceeds. That is whether it's less than 50 million euro or more than 50 million euro, and between the corporates and obviously the corporates are the ones which have more exposures more than 50 million euros, right? And apart from that we have the retail exposures. So basically while we spoke about those retail exposures and the corporate exposures, while we speak of the corporate exposures, we saw that there were different subclasses of these products, right? Of this exposure, and namely they were the project finance, they were the object finance, they were the uh, income production, income producing real estate. We had the commodity finance, and we had the high volatile commercial real estate, right? So this is where we have this. So the next thing that we talk about is project finance. So over here, what we are trying to do is we are trying to do, so what we are trying to do is what, you know, whether there is a we are trying to explore the different kinds of corporate exposures that we would have, like we would have project finance, right? So let's talk about project. So while we talk about these exposures, right? So the question that comes out is that what we need to understand over here is that how exactly are these are different from each other, right? So we spoke about project finance and object finance. We'll explore the different characteristics of these exposures and see how they are different in between them. And given that we want to understand, we would need to understand what are the sources that we would focus on while we are trying to assess the viability of the projects, right? So that's the part that we will be doing over here. And similarly, we would be looking at it for the retail exposures as well. So there are a lot of these different things that we are looking at, that we are trying to study, right? So let's get on with that. Okay, so first of all, the first question that we have over here is that a project, what is a project finance? So what happens over here? Okay, so this is a method of funding, right? Where the basis of the funding, where the basis of funding is the revenues generated by the project, where the basis of funding is the revenue generated from the projects, is the revenue generated from the project, rated from the projects. Now, this very point that we have over here, right? So this very point that we have over here is something which we are looking at. Right? So this is the basic of funding is revenue which is generated from the projects, right? So think about this project. What are the now this is what the revenue is. So this is what the description of the exposure is. Now what are the implications of this project? So that means this finance or this mode of financing is done to industries which are cash rich industries, industries which are cash rich industries, which are cash rich. Now when I talk about cash rich industries, what do I mean by this? So what do I mean by cash rich industries, which are cash rich? So that means where you have very sufficient, where you have a substantial flow of cash, or the cash flow is very rich, right? So if the cash flow is very rich, right, then what is it that you are trying to look at? So this cash flow is the revenue which is coming in, right? So there are heavy cash flows in these industries. So think about the fact that there is a, so let's say there is a Flipkart which is opening, right? So now while we talk about there's a Flipkart which is opening, now assume that there is no venture capitalist and these level 1 level Z funding and things like that. So over here what we are seeing is that, let's say that it's still a pre 1991 world, and in India, so it's pre-99 world, it's a pre-startup world, and Flipkart has to reach out to these banks, reach out to a bank, or like to a bank like a Citibank, asking for credit, right? So now, when this happens, or when this particular thing happens, uh, so when this particular thing happens, so obviously, if the bank is trying to do a project finance, so what will it see that okay, that Flipkart is trying to sell retail products, so they'll sell this, they'll get heavy cash. So I would expect them, so I would give them the funding based on the revenue which they are likely to generate. So these kind of, so this will be a heavy cash flow based industry. But where, however, When I'm talking about this, I'm talking about a specific manufacturing industry, right? So where there are heavy cash flows, and the loans which will be backed, they will be backed by the cash flows. So what are the key factors that that a bank would be studying in front for this obligor? So let's say there is an obligor who goes onto the bank and asking for a project finance loan, or a project finance loan, and thereby being a part of the project finance exposure. What is it that the bank is going to look at? The bank is going to look at certain matrices, certain key matrices. What are those? What are such matrices? So let's say one of the matrices that the bank would be looking at will be matrices like the EBITDA, that is earning before interest, tax, depreciation, and amortization. The EBITDA measure. So I'll just put this once again over here as earnings before interest, earnings before interest, tax, depreciation, and amortization. Amortization. So over here, what we have is that earnings before interest, tax, depreciation, and amortization. So this is a measure of the revenue. So this is also the EBITDA also works as a measure of profitability for the bank. So this is a measure of profitability for the bank. Right. So over here, what we'll talk about is the measure of profitability. Right. So there is a measure of profitability. This EBITDA that I have over here is a measure of profitability for the bank. Now, while I talk about this EBITDA, so there are other measures as well. So so basically what you are trying to see is you are trying to see into the factors which explains the cash flow that the bank has, right? So mostly these loans. So mostly, if I were to design a product, right, what I would essentially do is I would try to you know I would try to look at I mean, I would like to look at those factors, or if I were to derive a, design a product for this, I would be mostly defining a cash flow loan kind of a product loan, which is backed by the cash flow of the firms, right? So basically, let's say another measure as a bank that I would be generally looking at, apart from EBITDA, should be the free cash flows, because the more the cash flow, the influx of the cash flow is, the better is the bank, I mean this borrower, right? So there is a free cash flow. Be the free cash flow. So the question that comes out over here is that how do we define a free cash flow? So free cash flow that a company is, so it represents the cash flow that a company is able to generate, after laying out the money required to expand or maintain its asset base, right? So money, so cash flow which is left which is left from where? From, I would not use the term left, which is cash flow generated after the cash kept for expansion, for expanding physical assets. Of maintenance and expansion of the asset base. Right? So over here, what I have is the cash flow generated after the cash kept for the expansion of the asset base. So this is something which is there. So we have the EBITDA, we have the free cash flows, right? So these are so this is another measure. Similarly, uh, the bank may look at the enterprise value and so on. So these factors which capture the bank's or the borrower's ability to generate cash flows are the ones which would be considered while I would be giving out a project finance loan. So these are the kind of variables that we would look at, or at some other variant of this variables, right? So up to this point, is it clear to us?
Yes.
Uh, Vishwarup, are you saying something?
No,
Okay, okay. I
I
saw
guess
your
we
mind.
cover that. No, I believe we will cover that. I was about to ask then what would be the difference between the project finance and income producing.
Yeah. I'll come to that as I finish, as I move on the asset classes. I'll come. Okay. Okay. So the next part that we have over here is, so this is how the funding is done, right? Now the question that comes over here is that I have so I'm trying to do the funding. Now, one of the, so therefore the key component that I have over here for project finance is the revenue. The question that comes out over here is, how do I use or adjust the revenue? Now this revenue, that is the revenue that we are talking about over here, is obviously an expected revenue. So this revenue is an expected revenue. Now, when I'm talking about this expected revenue, so the question that comes over here is that what are the users that you want this expected revenue to be put in, right? So you can use this revenue. So this expect under project finance, right? The contract is so designed that you expect the revenue, or so you can use the expected revenue for, one is repayment of the loan, right? The repayment of the loan. The second that I have over here is it can also be used as a security against the exposure. Security against the exposure. Right. So these are the two uses to which the borrower can, so to which this expected revenue in a project finance can be used for, right? So on one side, what we have is, on one side, what we are trying to do is we are using this revenue to repay the loan, right? In case of a default, this revenue will act as a security against the exposure. So that means the bank will have a first lien on this revenue that is generated in the event of an impairment, right? The bank will have the first lien or the first right over the revenue on revenue which is generated during on revenue generated since the state of impairment. Since impairment, so once it is impaired, right? Once loan is impaired, right, and the borrower has been unable to pay and he is generating revenue, so before he uses the revenue for any other purposes, the chunk of it has to be given to the bank as a payment towards that. So in case of an impairment, this expected revenue of the bank, or the expected revenue will play. So whatever revenue they earn, they first need to pay the bank the desired amount on a timely basis, and then they can use the remaining thing. So even under a situation of impaired or a crippled revenue. So this is, so the bank will have a first lien in the state of an impairment once the state of an impairment is detected, right? So over here, this cash flow, this expected revenue, this cash flow is used both as a repayment method. So you are actually repaying the loan using this, uh, using the revenues that are being generated, and on the other hand, you are generating so you are kind of in the situation of an impairment, you are using it again as a security against this exposure. So that's something that we have over here. So we have there is a kind of a first lien which the bank would have on the revenue once there is a situation of an impairment which crops up, right? Okay. Now the question that comes over here is that I have kind of spoken. So now the thing is that how does, or for what kind of projects does this kind of a finance or this kind of a exposure arise? So what kind of projects that we should look at? Okay,
A road construction project.
kind of a construction project. It can be any kind of installation project, like power
Okay.
plants, electricity plants, transportation, mines. So any kind of heavy industry where there is a lot of so which are really very cash heavy industries, in the sense that these are very revenue heavy industries, not like a typical Flipkart or an Amazon, because where you don't have revenue and promise of revenue generation, right? So that's the reason why this. So that's why. So we would be preferring traditional cash heavy industries, right? Okay. So the question that comes out over here is that what are the key type of projects that we look at? So what kind of projects that do we have? So we have like complex installation projects. Complex installation and heavy industry projects. And a heavy industry projects. So what kind of projects do these have? That are we talking about over here? We are talking about power plants, mines, etc. So we have power plants, we have mines, we have etc. So over here, what we have is so these are some of the relationship that we would have. We would have power plants, we would have mines, transportation industry, transportation infrastructure, etc. Let's say so bridges, flyovers, and stuff like that. So these are so these kind of industries, right? Electricity generation, chemical plants fall under this kind of installations, right? Or under this kind of financing. Now, while we have defined the projects, right? So while we define the projects, so one of the biggest question that comes over here is that what are the ways of doing? So what kind of ways will I be drawing the finance? Right. So one of them is financing the construction of new installation, financing the construction of new installation. Of new installations. So basically, if so, whenever there is financing the construction, so whenever we have new installations, so financing the construction of these new installations is an important part, right? The second is refinancing the existing installation. So the next that I have over here is the refinancing of the existing installation. Existent installation. So refinancing the existing installations. So basically you can either build up a new installation, or what you can be doing is you can be refinancing the existing installations. Right? So basically the way, whenever I'm trying to assess a exposure, so the first word, the way I'm trying to look at it is that what against or how exactly is it that this product is structured. Then what we are seeing is, so we see that what is the key basis on which the loans are sanctioned. So it shows that one of the key factors that is there is the revenue is generated from the project. So the revenue generation of the project, which is very important over here. The next question that comes over here is that, okay, if it is this revenue, so how do you look to use revenue? So one is it can be used to repay the loan, and the other is it could be used as a security against the exposure. Now the next question that comes over here is that, okay, this is how the revenue generated, but the question is for what type of projects is this revenue generation possible? So that's where we talk about complex installation. So installation projects, that is power plants, mines, etc. And then we say that for these projects, when you are taking the money, right? So when the money is granted, so either the money is granted with the construction of new installations or refinancing the existing installations, right? Okay. Now the question that comes over here is that how now if I have to define an exposure, one very important thing that I need to talk about is the payment. So how does the payment stream or the stream of the payments would come in when we are talking about project finance? Okay. So over here, while we talk about this, so now the next question which comes, or so obviously which will become very important at a stage is the repayments. Okay. So okay, so the question that comes out is that repayment. So how exactly the repayment is done? So this is paid solely. Okay. So these payments are done mostly or solely. Okay. Okay. So over here what we have is payments or the paid made solely out of the revenue. Okay, so over here, what we are trying to see is that either the payment is made of. Okay, so payment made from the revenue generated. Okay, okay. So what we are trying to talk about is payments which are made from revenue. Okay, so payments which are made from the revenues. Now, this payment which are making are we are either making solely. Okay, so partially or solely. So, so one of the important characteristics of this project finance is that the revenue that it has. So while it is backing up, so that means so the way the transaction is done is that the lender is paid almost solely or partially by the revenue, right? So therefore, this the repayment depends on the project's cash flow and collateral values of the project's assets. So it is both the cash flow as well as the collateral or the asset. So that's what project finance is. So basically, let's say that we are like so we are starting off in electricity. So there's an electricity provider who sets up his own power plant. Now what he does is he starts manufacturing electricity, right? Now once that has been done, what is the next thing that we have? So once that is done, the next thing that we do is that when the electricity manufacturer starts manufacturing the electricity and his revenue starts coming in, a part of his revenue is he's paying his EMIs. And in case he defaults or any of these bad events happen with him, what they are trying to do over here is they try to so they use that as the collateral to repay the loans, right? So that's basically what we would have over here, right? So this is what the project finance or the exposure of project finance is, right? So any questions up to this point? Okay. So something similar to the project finance is the concept of the object finance. So like over here in a project finance, the bank is trying to finance a, a full project end to end. Similarly, in object finance, the bank is not trying to project kind of, they're not financing the whole project including installations. They are in object finance different kind of objects, commercial objects, like it can be ships, it can be aircraft, it can be satellites, it can be fleets. These are the kind of assets which are being finance. So an object finance it cannot be treated as the same as the project finance, because in project finance what you are doing is you are financing the end-to-end installation and execution of the project. What so in a versus in an object finance you are just kind of supporting the purchase of that fleet. So so this is so the way the finances happen is very different. That is the reason why this could not. So now if I have a I buy a ship, right, or I buy a fleet. Now I don't have a garage or a place to save the fleet. I can't, that can't be here. So that does not come under part of object finance. However, if it's a project finance, right from the entire land right up to the installations and everything is captured, is taken under project finance. So over here we have these different. So this is basically the difference. So basically for object finance I buy the fleet, but if I don't have a space to store that, that's my problem. That is not being financed by the bank under that loan, right? So that's the way our object finance and the project finance would be different from each other, right? So so it is funding. So object finance is like funding the acquisition of the physical value, right? Now, when you look into the repayment of the exposure and when you are looking into that part, right? So so the revenue generated over here is again I mean so it depends on the cash flow which is generated by the asset. So basically when I'm thinking of repaying the loan, it is something very similar to what project equipment finance was. I mean project finance was. So over here we have the cash flows generated by the asset, and the cash flow generated by the asset is used for creating or is used for financing, and the financial and the debt service capacity of the borrowers are important observations on object. So and that is important, right? So so over here the theoretical and the the finance, the financial, the debt servicing capacity of the borrowers are important over here, as well as the cash flow is over here, right? So now if I'm looking at the debt servicing capability, then I will be looking into other borrower specific variables as well. So I'm not just looking into the ability of the firm to generate the revenues, but I am also looking into the firm's ability to service debt, right? So that's what object finance is. So object finance and project finance are something which is different, which is slightly different. But the key sources of risk which would be affecting the probability of default for these kind of financing will be mostly very similar to each other. So it would be they would be something which is pretty nice over. Right. Okay. Now, what will be the primary source of this cash flow for object finance? It can either be it's 9 o'clock. So it can either be a lease, kind of a form. It can be a contractual sales, it can be contractual other revenues, stuffs like that. Right. So these are the two broad sources of the the finances that we have over here. Right. Okay. Now, one very important thing that we need to understand between this project finance and object finance is that the mostly these balance sheet variables, like now again, before for both these two kind of loans, so one very common variable will be the borrower's ratings, the ratings that are available. There are balance sheet variables and so on. Right, so these are the two most. So out of the commercial portfolio, uh, project finance and object finance are actually very, so these two are very important factors. Now similarly, a variation of object finance is a franchisee finance, a similar kind of a financing framework where the loan is given not for the entire project or the equipment, but for acquisition of a franchisee and setting up that franchisee. So a franchisee setup or franchisee financing would be something in between a project finance and a object finance. So we will be talking about franchisee finance as well, also as a product going forward. Right. So these are the two most important sources of finances that we have. Now, apart from this, there are these other products like the income generating real estate and the HV, CRE and commodity finance. So before we go into this, we look into commodity finance as well, and from there we look into the the income producing real estate and the highly volatile uh, commercial real estate. So these are the next two things that we need to talk about. Okay, uh, fine. So guys, just let's take a pause here for the day. Right, I have uh, a hard stop today because of an office meeting today. Let's regroup this Saturday evening again. Okay, Saturday evening 8 to 9:30 we will finish off the corporate exposures and move on to the retail. Right, so I just wanted to finish the project finance and object finance which I had left off in last Wednesday, and let's regroup this Saturday again 8 p.m. to 9:30 p.m. I'll finish off this commercial exposure. Thank you. In the meantime, I'll upload these recordings. You can go through them before the Saturday session.
ठीक है भैया.
Thank you.